The topic today is Brexit, the future of the UK economy, and where might the market be thinking about inflation, and is it right? To help us think about these issues, we're joined by George Buckley, Chief UK Economist for Nomura. Thanks for joining us, George. So I think you are in the camp which thinks Brexit is going to be a little bit harder than many people are going to expect. We may not get this big trade deal which Theresa May is hoping for. And maybe you could just outline briefly sort of what you think that means.
Well, to have a view on the UK economy these days, you have to have a view on what is going to happen with Brexit. I do think we'll get the free trade agreement. I just don't think we're going to get it in the lifetime of this Parliament. It's a very complicated thing to organise. And that will have an implication for sterling. It'll have an implication for inflation. When sterling falls, obviously, by 20%, like it has done already, it's going to have an upward impact on the rate of CPI. And we've seen this morning that CPI is now getting close to that 2% mark. It will go further than that, and we will still see higher inflation over the course of this year.
And this is tied up with sort of one of the big questions for sort of bond investors and the market, really, isn't it? Is this inflation temporary, or is it going to be sustained? And I think we've got here sort of a chart showing the market view of sort of the longer term inflation. This is the five-year break even. So sort of what inflation will be like. Is it from 22 to 2027?
That's right. And when you look at this chart, you can see, for example, that five-year inflation in the UK, the pink line at the top, is substantially not just higher, but the gap is widening between the UK and other countries like the US and the euro area. And I think that that gap might have got a bit too wide. The problem is when you get higher inflation in any country, what that does is, well, it helps exports, but it also is a hindrance to real household disposable incomes. People won't be able to consume as much. That will widen the output gap. And if it widens the output gap, it might actually mean lower inflation in the longer term. That said, for other countries, I think we should be bearing in mind that inflation might rise. Central banks have kept interest rates exceptionally loose. We've had a lot of quantitative easing. That could actually come back to haunt them over the course of the next few years.
And just in terms of the UK on this one, so you're not expecting any movement from the Bank of England anytime soon?
No, and I think they will think that inflation expectations are still anchored, despite the fact that we see, for example, this chart. This is another chart I'd like to point out. This is the forecasters, economists' view on where long-term inflation, 5 to 10 years ahead inflation, is going to be. It spiked up here at close to 3%. It's now come back down to 2%, the Bank of England's target inflation rate. So I think that the bank will be looking at these numbers and saying, well, at the moment, we're not worried about inflation expectations and wages taking off, but it's something that needs to monitor very closely indeed.
And I guess the thing that a lot of people looking at that might be puzzled by is the fact that sterling has dropped so much. And so import prices, we're hearing about these big price increases coming through. So I think a lot of people might be expecting, well, surely there has to be more of an inflationary effect from that.
Absolutely. Of course, this is a medium-term chart. In the near term, I would expect inflation to rise because of sterling. I think one of the reasons that it could rise quite quickly is that the UK is a very open economy. When economists like looking at these openness ratios, exports and imports as a percentage of total output, and when you look at those numbers, they're much higher in the UK. We are a much more open economy than, for example, the US, which is about half that, and also even the Eurozone as well as a whole is substantially less open. So the impact of a fall in the currency for the UK could be much more significant and much quicker than it would be, for example, from other G7 economies.
I see. So we'll work through it quickly, and then it'll pass through, and then inflation will go back to sort of where we're expecting it to be.
I think so. I think it'll be a short, sharp spike in inflation, which gets us to around about 2.75–3% by the end of this year, start of next year, then coming back off again. But there is so much debate about how quickly and how sizably this move in the currency will pass through. There's a debate on the MPC, there's a debate amongst economists. It's very uncertain. There are so many episodes in history where currency moves have or haven't passed through. 1992, for example, is a prime example. We saw a huge drop in the currency, but at the same time we had a large output gap, and that offset some of the impact of that currency fall on inflation. It didn't rise as much as you might have expected it to.
So plenty to think about before we even get into the question of how the Brexit negotiations go. Thanks a lot, George.
Thank you.